Hey everyone, welcome back to the channel. In today's video, we're going deep into an investment analysis on Telus Corporation. Ticker symbol T.TO on the TSX and TU on the NYSE. Whether you're a dividend investor, a telecom bull, or just curious about Canadian stocks, this one's for you. We're going to break down Telus across 5 key areas: cash analysis, technical analysis, fundamental analysis, risk assessment, and ultimately, whether this is a stock to buy right now. Let's start with something that doesn't get enough attention: cash flow. Cash analysis. Now, Telus is in the middle of a massive investment cycle. Over the last few years, they've poured billions into their fiber optic pure fiber network and the rollout of 5G infrastructure. That's great for long-term competitiveness, but in the short term, it has been draining their free cash flow. In fact, in 2023, Telus had negative free cash flow for several quarters. Why? Capital expenditures were through the roof, over $3.5 billion CAD. And while revenue grew steadily, the cash generation just couldn't keep pace. But here's the important part: those investments are winding down. Telus has stated in multiple earnings calls that 2024 and especially 2025 will see capital expenditures decline significantly. That means free cash flow is expected to rise, potentially sharply. And for investors, that matters. Free cash flow is what pays the dividend. It's what pays down debt. It's what can be reinvested into the business or returned to shareholders. So while Telus doesn't look cash-rich right now, the trajectory is encouraging. If management delivers on that free cash flow rebound, it could be a major catalyst for the stock. Technical analysis. Next, let's look at the technical side of the chart. Telus stock peaked in 2022, around the 34 Canadian dollar range. Since then, it's been in a pretty steady downtrend, bottoming out near $21 CAD in 2023. It's been consolidating in a tight range since then, between $21 and $24 CAD, forming what technical analysts call a base. Right now, the stock is showing some signs of a potential reversal. The 50-day moving average is curling up and approaching the 200-day. If we get a cross above, what's called a golden cross, that's often a bullish signal. It means short-term momentum is overtaking long-term trend, and buyers are stepping in. We're also seeing some accumulation in the volume patterns. Higher volume on green days, lower volume on red. That's a classic signal that institutions might be quietly buying. The Relative Strength Index, or RSI, is sitting around 55. That's not overbought and not oversold, basically neutral, which gives the stock room to run if momentum picks up. So technically, Telus isn't screaming buy now, but it's certainly not in a breakdown pattern either. If it breaks above $24 CAD with strong volume, that could confirm a new uptrend. Fundamental analysis. Now let's get into the fundamentals, where Telus actually stands out from the telecom crowd. At its core, Telus is a telecom company. They offer mobile, internet, home phone, the usual suspects. But what's interesting is their diversification strategy. Unlike BCE or Rogers, Telus has invested heavily in Telus Health and Telus International. Telus Health is now one of Canada's largest digital health companies, offering virtual care, electronic medical records, and benefits administration. Telus International is a global IT and customer experience provider with clients in tech, finance, and gaming. These two segments now account for a growing portion of revenue, and more importantly, they offer growth beyond the slow-moving telecom sector. Let's talk numbers. Telus has about $18 billion in annual revenue, with EBITDA margins around 35%. That's healthy. Net income has been volatile due to high depreciation and investment write-offs, but operating cash flow remains strong. The P/E ratio is about 20 on a forward basis, slightly elevated for a telecom, but well below some of the tech hybrids it's trying to compete with. And the dividend? This is where Telus really appeals to income investors. Right now, the dividend yield is hovering around 6.5%, paid quarterly. Management has a long history of increasing the dividend annually, and they've stuck to that even through challenging periods. That said, the payout ratio based on free cash flow is above 100%, which isn't sustainable in the long run. Again, the hope is that once CapEx normalizes, free cash flow will cover the dividend more comfortably. Telus also carries a lot of debt, over $22 billion as of their latest filings. The debt-to-equity ratio is over 1.5, which is high. But that's not unusual for telecoms, where infrastructure investment is essential and long-term in nature. What matters more is whether they can service that debt, And Telus still has a decent interest coverage ratio above 3x, enough buffer, but not bulletproof. Risk analysis. Now let's talk about risk, because no stock is without it, especially one in transformation like Telus. Risk number one, execution. Telus is betting big on its digital health and international segments. If those don't scale as expected, or if competition heats up, the company could be stuck with high debt and low growth. That's a dangerous combo. Risk number two, regulation. In Canada, telecoms face strict regulation. The federal government has been vocal about reducing consumer costs and increasing competition. If new policies force Telus to lower prices or open access to third parties, that could compress margins. Risk number three, interest rates. Telecom. And rising rates hurt. Not just by increasing borrowing costs, but also by reducing consumer spending. Higher interest rates can delay mobile upgrades, internet package expansions, and CapEx investments. And finally, risk number four, market sentiment. Telus is a dividend stock, and when rates are high, dividend stocks often fall out of favor. Investors can get 5% or more on a risk-free GIC or treasury bill, so they don't need to chase telecoms unless there's growth or capital appreciation on the table. All that said, these risks are manageable if you have a long-term horizon. Telus isn't going bankrupt. The question is how well it transitions from a pure telecom to a tech-enabled infrastructure and health business. Buy recommendation, so let's bring it home. Should you buy Telus right now? If you're a short-term trader looking for quick momentum plays, Telus probably isn't your stock. It's still in a consolidation phase, and the real upside depends on macro factors like rate cuts and sector rotation. But if you're a long-term investor focused on income and stability, Telus looks pretty attractive. You're getting a 6.5% dividend yield, exposure to digital health and IT outsourcing, and a company that's nearing the end of a major CapEx cycle, which could unlock serious free cash flow starting next year. The stock isn't dirt cheap, but it's trading near its 52-week lows. That means much of the bad news, high debt, high CapEx, slow growth, is likely priced in. So here's my take. Start with a small position. Scale in over time. Watch for confirmation of the free cash flow rebound and keep an eye on that 24 resistance level on the chart. If you're patient and willing to ride out some bumps, Telus could reward you with steady income and modest capital gains over the next 3 to 5 years. So I'd call this a moderate buy for long-term, dividend-focused investors. That's it for today's deep dive on Telus. If you found this useful, hit that like button. And if you want more long-form breakdowns like this one, make sure you're subscribed and turn on notifications. I'd love to hear your thoughts in the comments. Are you holding Telus, waiting for a better entry, or are you avoiding telecoms altogether? Let's talk investing down there. Thanks for watching, and I'll see you in the next one.